All right. Today is Monday, the 26th of May. Happy Memorial Day. I hope everybody got a chance to get high, get drunk, and you shoved your face in a bunch of hot dogs. And maybe you've done something patriotic, because, that's what the holiday is all about. It's not about stuffing your face in food. My patriotic gesture was when my wife asked me to bake a cake. I baked an American flag-shaped cake. Easy. 3-minute stop. All you need is just a bunch of cottage cheese, strawberries, and blueberries, and boom. Here you go, honey. Back to the grill. Anyhow, this is a recap for the stock market activities for the week that was, and an outlook for the week to come. And folks, I got a good one for you tonight. There are a lot of experts out there talking about the market right now, and they talk about technicals and mechanics and the options market and the fundamentals and corporate this and corporate that. None of that matters. Take all of the technicals and shove it up your butt. You know why? Because we're trading right now based on the psychology of the dear leader. And who understands him better than I do? You see, it's been about a couple of weeks since Trump went to the Middle East and got his ego stroked. The guy was happy. Smile ear to ear, doing all this cool stuff over there. But now he comes back and realizes that he needs another ego stroke because he's powerless. Everything he does, the courts throw away, including his own Supreme Court. So how do you restore a little bit of ego now that you're not in the Middle East? And it's been 2 weeks, and all what the courts do is just dismantle everything you've threatened to do and wanted to do. How do you restore a little stroke of ego? One thing you can do, of course, is tariffs. At least for now, the tariffs are not being challenged by the courts. So the president has absolute power to do tariffs whenever he wants to, take them out whenever he wants to. And that's going to be the card that he's never going to give up. So all of you who said, Orange Man is just bluffing and he's just not going to do anything. You got to buy the dips all the time. No. He believes in this because A, he's been talking about it for a long time. B, it's the only card he got to keep his ego stroked. So he's not going to give that up. You got to be an absolute fool to believe that the tariffs are not going to be a card that is used over and over and over again. At the end of the day, they're probably going to be here to stay. Anyhow, what does he do to restore the ego stroke? Look at our largest trading partner, the EU, which is, by the way, we trade more with the EU than Mexico, Canada, and more than China and Japan combined. And of course, since we have a massive trade deficit with the European Union, which kind of exploded once Trump became president, why not restore that ego stroke with slapping a 50% tariff against the European Union? And of course, the market reacted negatively, it went down, but then folks said, he's just bluffing, he's not going to do it, so why would I panic and sell? I got to buy instead. It was a debate in Friday's session, but all in all, it was a negative reaction by the market. Now, rest assured, over the weekend, we got some news that the tariff that he slapped or threatened to slap are now unslapped, as Trump delays the 50% EU tariffs from June 1st to July 9th. You know who's not getting unslapped, though? It's this French President Macron. Oof. Take a look. The worst part of it is he tried to make it up by, extending his arm, hold my hand, and she wouldn't even take it. So that's a double whammy. But back to the tariffs. Now that he said he's going to do it, that he's not going to do it, that he's going to delay because somebody kissed his ass and gave him the ego stroke that he needs. It's all about his psychology right now. But I think that we headed to a point here where the market is going to look at this as negative either way, because we're getting close to these 90 days delays, be it on China or the rest of the world or the EU. We have so many 90 days deadlines. It's so confusing. And at some point, you got to say, you know what? I'm out of this until they sort it out. I'll take the summer off and come back later and see what happens. Of course, when you come back later, the market will be already crashing because I don't think we get a resolution by the summer. The deals are not happening, not going to happen. And at the end of the day, you have to resort back to the tariffs for 2 reasons. It's the only card that allows an ego stroke for the White House. Number 2, it's the only way he can plug the massive budget deficit that we got based on the bill that the House passed last week. On top of that, the Europeans probably not going to get a deal by July because they're already kind of retaliating. We got some news against Visa and MasterCard on Friday with the EU antitrust scrutiny. And of course, fines on Meta, fines on Apple, fines on Amazon. So the EU is not only the largest trading partner for the US, but they also have other tools to punch back, including slapping fines against US companies. And the other thing is, of course, the EU is kind of impossible for them to get a deal by July, let alone June, because you have European Union has all of these nations, and maybe their interest is going to overlap in some points with the US, and in other points, it's not. Matter of fact, it's going to be a point of conflict between nations re the trade with the United States. So you have Hungary having different goals than Germany, for example. Italy maybe has different goals than France. And that could be problematic for making a deal. And the other thing is, maybe, and again, you better hope that I don't become a White House advisor, because if you remember what I said last week about Trump and Apple and how he's going to punish Apple, because he will listen to the last person that he talks to about the matter, any matter. And maybe that last person is me. For all you know, I'm a White House advisor. Take a look. So that's inflationary. And of course, the beauty of all of this is Trump right now is pissed off at Tim Cook. A, he didn't show up in Saudi Arabia. B, he wants to increase the prices of the iPhone, which is inflationary. C, he wants to shift the manufacturing from China to India, and Trump is not cool with that. I think that Trump, if you talk to him, because there is this, it's not a rumor really, it's pretty much a fact at this point, because we heard the same story in the first presidency of Donald Trump, that he's influenced and he takes decisions based on the last person he talks to. And I just wish I had some access to the White House. I'll be the last one to talk to Trump at a certain night, and I would say, Mr. President, you know that iPhones are the ambassador of the United States to the world. It is our top product. It is the best-selling product that everybody in Germany, and UK, and Japan, and China, and Saudi Arabia, and Egypt, and whatever, Brazil, they got iPhones. That's our product. That's USA product, our pride. Why the hell are we manufacturing that in India or in China? It has to be made here in the USA. And you know what Trump is going to say? Yeah, I agree with that. He's going to be influenced with that. He's going to attack Apple big time. I'll be buying puts beforehand, of course. Make a shitload of money. The next thing you know, of course, Trump is slapping a 25% tariff against Apple products if they're not made in the US. And this is something he's not going to give up because he just likes the idea. He thinks it's cool to make iPhones in the US. He's not going to give it up. Maybe at the end he's going to settle down to, Apple promises that they're going to do made in USA iPhones by 2030 or whatever. But right now, Tim Cook, is in a tough corner because Trump is not going to let this go. And despite all of the ass kissing that Tim Cook has done so far, he forgot that his lips should be placed on the president's ass for the next 3.5 years. You can't just do the first half of the year and then let your lips go. The ass kissing has to continue. If you don't, you're going to get punished. And now we see Apple, of course, there's no way out of it. Before the 25 tariffs, listen to this. For the iPhone Pro Max 16, that's the top of the line, I guess, it cost Apple about $649 to make the phone. Because you have all of these parts, some of them come from the US, some of them from Taiwan, from China, South Korea. If you do just the final assembly in the US, no reciprocal tariffs at all, the cost of this iPhone will increase to $809. Now, if you implement the reciprocal tariffs to assemble the iPhones here in the US, the cost will jump to $1,242 a pop, a 91% increase in price. Now, we add the 25% on top of that, and it just gets disastrous to the point where you have Clown Don Ives, also known as the Thupathackle. And the Thupathackle never happened, by the way. Where is the Thupathackle? Anyways, but Clown Dan Ives says that iPhone prices will go as high as $300 to $500 a pop if we manufacture here in the US. And that is unrealistic in our view. Now, when you make Clown Dan Ives the voice of reason, you're doing something really horrible. So my warning to investors, and specifically European friends watching the program right now, don't take too much comfort in the extension of the 50% tariffs all the way to July. You know why? Because the secret White House advisor might show up tonight in D.C., calls the president. It's the middle of the night, because we know he stays up all night. Mr. President, sir, I can't go to sleep. I got a couple of Big Macs, bunch of chicken nuggets, fries, Diet Cokes. What do you say we talk a little bit here? And then talk the president into, I know you delayed or you're thinking about delaying the tariffs. to July against the EU, 50%. But you know what? Maybe it is in the national interest of the US to begin to break down the EU. We don't want them to compete against our currency. The dollar is down the toilet and they might take over. And furthermore, Mr. President, sir, isn't it in our interest, our national interest, to break down the European Union into smaller countries so we can make deals with them individually without the whole cabal, as we've done with the UK, Brexit? Now we can do a deal with the UK easy. So I don't think you should remove the tariffs, Mr. President, or delay them. Maybe you should hit them hard. That's going to crash the euro and it's going to pin them against each other, and then we carve the EU to little pieces. Let's make a deal with Italy alone. Let's make a deal with Hungary alone or whatever. And you know what? You know what President Trump is going to say? He's going to really love that idea. He's going to sleep on it, wake up the next day, and increase those tariffs to 100%. So word to the wise, don't take too much comfort in the delaying of the tariffs, because I don't think it's going to save the market either. And speaking of, since we're going to talk about the market right now, let's review our strategy from last week and what is the new strategy. Because as I said before, you can study the technicals all you want. You can study the options market all you want. You can study the fundamentals and corporate earnings all you want. Nothing is going to matter. At the end of the day, the market is trading based on one man's psychology. So it becomes really hard to navigate the market, and you need a strategy week by week. Last week, we shared all of this with you folks in last weekend's video. You can pause to read it for your own, but the concluding note from 5/16, May 16th, I talked about how now that the president is coming back from the Middle East, his focus will shift toward tariffs again. And this is why I think that we've overdone the reaction to the China deal, and we might begin to pull back. Indeed, we pulled back this week. And we decided to take advantage of that by riding some credit spreads we've done in the week before on the E-mini S&P futures. And that's working out so far so good. We've added some call credit spreads on the NASDAQ futures, raising a nice amount of cash. And so far so good, because the NASDAQ futures pulled back and not threatening to trade above 22,000, which is the leg that we sold anytime soon. I think we're going to head down from this point on, and we're going to be stuck in a range. So I think the trade is going to work out, so we're going to continue to hold on to it. Number two in the strategy, we said that we want to hedge all of the portfolio. The VIX is low. It's not going to stay too low for too long. When it's under 20, you want to take advantage of that by hedging your portfolio, because once it pops above 20, hedging becomes expensive. And I've done that throughout all of my portfolio, and the Chinese names specifically. And this week, we've seen the VIX going higher, so the cost of hedging went higher. In other words, our timing to hedge is pretty good. We continue from the concluding note from last week. Number three, added GDX calls, expiration date in June, and I said that I think that gold and gold miners will catch a bid in the second half of May. Well, guess who was the top performer this week? What you're looking at right now is the heat map for the week. If you see, the GDX scored gains of over 9% this week alone, while the market was down in the red. The gains in gold miners surpassed the gains in actual gold, surpassed the gains in even Bitcoin. The trade was the GDX 46 calls, the expiration date June 20. We've done that back on the 14th of May. Then on the 20th, this week, gave you an update. We booked profits from the 46 calls, 100%, and then we rolled to the 50 calls, same expiration date. And we closed that also at 140% worth of gains by the end of the week. And by the way, I don't think that gold is done. We'll look at the charts in a minute, but back to the concluding brief from last week. Number four, keeping my pullback swing trades for May 30. We also shared that in Options Tracker, so these were the swing trades. We got SMCI Supermicro 40 puts, May 30. The expiration date, AXP for American Express, 295 puts, expiration date also May 30. Win with the 90 puts, AVGO Broadcom with the 210 puts. All of these worked out. The exception is AVGO with the 210 puts, but that might work out as we hit this week because we got NVIDIA's earnings, and that could impact the rest of semiconductor stocks. But we closed SMCI, that was on the 23rd, spent about $155 each, including the roll, and then we closed it with $2, so we pocketed a nice amount of gains. And then we've done AXP, we closed it on the 21st, entered $3, exited 5.35. Wynn Resorts entered, of course, at 50 cents, closed at 65 on the 20th. Some of you held on to it longer, and you made 100%. On the 14th, we also entered Apple 210, 200 puts. The debit spread, the expiration date May 30, cost us about $2.65. The trade is still open, and of course, with the bad news that we got against Apple, the trade is working out pretty good. We've also done one by mistake, a weekly put options trade against Apple, the 210 puts, expiration date 23rd. Well, guess what? It worked out, even though it was a mistake. 259, the entry, 504, the exit, almost 100%. That's pretty good. One that didn't work out, we got Google, 165, 160 put debit spread, the expiration date May 30. Cost us about $2, and we entered that on the 15th, but Google was catching a bid this week. At least somebody was buying, some of these hedge funds, maybe Snake Blackman, who knows, was buying Google over and over and over again every day, so the stock was going higher. It became clear to me that the trade is not going to work out. So we fixed it by closing the trade, netting 60 cents, and then switching to the call credit spreads. We sold the 170, we bought the 175. The expiration date was for the 23rd, netting a credit of about 2.30. So all in all, we got 290. Well, guess what? Google closed below 170 by Friday, the expiration date of the 23rd. So all in all, we've netted about 90 cents. Not a bad profit, about 1/3 of the investment. Going back to last week's strategy, we talked about number 5, converting TTD earnings calls, 70 calls that we got into shares. And right now, TTD Trade Desk pulled back a little bit, but still trading above $73 a share. So we're still profitable. If you're scared about it, you can buy the 70 puts 2 weeks to the expiration and have an insurance policy to sleep tight at night. Number 6, added some shares in dividend-paying stocks like AMGN, Bristol-Myers, Procter & Gamble, Duke Energy. But I don't know if you watched my latest video. You got to consider the fact that every time we've seen the 10-year yield moving above 4.5% and the 30-year bond yield moving above 5%, the attractiveness of dividend-paying stocks diminishes, and we see folks actually dumping them and switching to fixed income. So while I added to these positions, I'm also hedging, and I showed you exactly how am I hedging against my dividend portfolio. Number 7, we've done a diagonal put spread in JPM, buying the June 20th 250 puts, and we sold the 240 puts for the expiration date of May 30. Cost us about $1.70 a piece. Right now, as of the recording of this video, the trade is at about $3, so it is already profitable. Now, I don't think that JP Morgan is going to close below 240 by the end of the week. So suppose it goes down in the ideal scenario below 250 but doesn't close below 240. The leg will expire worthless, the 240 that we sold, and we can open a debit spread at that time selling the 240 for June 20. Or we can open another diagonal and increase the chance of profitability as we go. So that was the strategy from last week. It did pretty good, I would say. What about the strategy for this week? We've been spinning it out throughout the week, by the way, in the morning briefs. On my Discord, the 21st, I said good morning, and I showed you that if we lose the E-mini S&P 500 futures 5,900, that's the support. If we do it, we're going to go down in the bag to 5,800, and that's going to be about a 2% correction. This is the chart of the E-mini futures once we lost 5,900. Indeed, we went down to 58 in less than 2 weeks, took 2 days, and we went down more than 2%. Now we see a rebound closer back to 59 since the tariffs against the EU were delayed. We're going to discuss the chart in a minute, but we also talked about the VIX. The VIX, if it closes above 20, it's going to change the dynamic in the market. You need to hedge. You need to book profits from upside bets and maybe begin to switch to some downside bets. And indeed, we've seen the VIX closing above 20 this week. Then we talked about copper futures. And by the way, as the dollar continues to devalue, because there is no other way. See, when the bond auction came out bad, it came out because our sugar daddy, who's supposed to buy our bonds, needs a sugar daddy. So the only buyers that we got left is the Federal Reserve and Scott Bessent, the Treasury. All of them need to print dollars to buy the bonds. And as they do, they devalue the US dollar. And you can play the weakness in the US dollar, of course, by betting on other currencies or buying metals. In this case, we said, let's buy copper. Gave you the chart right here that we're going to see a bullish breakout. Here's the update for you. We got the breakout, and I think we have more gains to come in copper, in gold, in palladium. We'll talk about that in a minute, but this week's strategy, we talked about selling the GDX booking profits, and we're probably going to reopen GDX gold miners calls this week again. We have also made an update for a Tesla trade that we got because Tesla looks a little bit excessive right now in the rebound, and it might begin to pull back. So we've done a trade on it, and here's the trade. We sold the 320 calendar puts. We bought the 30 this upcoming Friday, and we sold the 23rd. So that already expired worthless. And now we have the 320 naked, as suggested in the stream with the Top Guns, that you open the 310 as a debit spread for next week. And had you done that, you've netted about $2 at the time and covered 2/3 of the investment, the $3. In any case, if you did not like me because I was busy, what I've done is rolling the trade for about 25 cents. We went with the 325, 315 put debit spread for June 6th instead. And that actually ups the odds of winning the trade to above 30%, which is what you need to keep your trade open. We've done that for 25 cents, so I think that Tesla is going to begin to pull back and the trade is going to be okay by the expiration date. Now, our strategy for the European tariffs. Number one, I did buy the EWG, that's the German ETF, 41 puts, the expiration date June 20, cost us about a little over $1. I also bought puts on DB, that's Deutsche Bank, same expiration date, about $1. And as a hedge, I bought shares of the UK ETF EWU. So the strategy basically is short Germany, long UK, because Germany is going to be the biggest casualty from these EU tariffs. And the negotiation is going to be harder. But we already have a deal with the UK. So all in all, you see the performance of the day on Friday. The EWU, that's the UK ETF, was actually positive. The EWG, the German ETF, was the biggest loser, down about 1%. We have also exploited the shortened trading week, the Memorial Day trading week, because we're losing a day. So why don't we write some options on bets that we want to do later on? So what I've done here is I sold the 5,700 puts on the E-mini S&P futures for the expiration date of this Friday. I don't think we go down to 57 or below by this Friday, but I bought the 56 as a hedge against it. And then I bought the 5,700. Those are the puts for the expiration date of June 20. I think we can go down to 57 and below by June 20. That's more realistic. Then I sold the 56 puts, expiration date June 20. I think we maybe go to 56, but we're not going to stay below or trade below for too long by June 20. All in all, the trade cost about $4.50 a pop, has a chance of profit of 70%. Now, as long as we don't trade below 57 by this Friday, the trade is going to be fine. If we trade below, it's not the end of the day, too, because we have other options. We have the 57 for the 20th, which will also appreciate in value more. So for now, the idea is to exploit the short trading week by being in the market maker's shoes, by writing options on bets that you want to do later on, whichever way, whichever ticker you want to choose. And of course, we're going to update you with a new strategy by the end of the week. So folks, join us as a member, Maverick member, Patreon, YouTube, and then join us on Discord too. But let's do some charts and then wrap it up. What we see here overnight, looking at the E-mini S&P futures daily chart, we are still trading below the 200 days moving average in orange, as you can see. We're also forming a bear flag pattern. That doesn't look good. On top of that, we have a rollover in the momentum indicator, the MACD, from bullish to bearish. These are not good signs right now. We need to close above the 200 days moving average again to show progress in reversing the damage that we got last week. How far can we go if it is indeed a rollover in momentum, a bear flag, and a loss of the 200? How far can we go? Plug in the 50, and the 50 is in blue at about 5,600. That is the leg that we sold. Maybe it happens before, maybe it happens close to it, who knows? If it happens before, the trade is still profitable, the one that we've done. That'll be from the 200 days moving average, a drop of about 4.5%, which is reasonable after a massive rebound as we've gotten lately. Now, looking at the weekly chart for the E-mini futures, what I'm trying to highlight here is we had an upward trend with higher highs and higher lows since late 2023 all the way to late 2024. These next weeks will be really, really important because if we don't recover more in the chart that you're looking at right now, if we head down instead, it's going to be the first time that we've seen a lower high in the weekly chart of the E-mini futures since the year 22, which was a bear market. And it's going to begin to formulate a series of lower highs and lower lows. We've seen the same phenomenon when the trend reversed. We've seen lower lows, lower highs in the year 22. That is the shift, of course, to the bear market. So it is really critical for the stock market to recover this week and not trade in the red. Because if that is the case, then we have a lower high. The other chart you need to look at is the 30-year bond yield. And the important number here is 5.178 basis points. A close above will be the first time we've closed above that number. It's going to be the highest rate in the 30-year bond yield since the year 2007. Now, that crashed the economy back then. And I said repeatedly in the program, and I showed you the evidence in the videos that we've produced last week, that the level of debt increased dramatically since 2007. The debt to GDP ratio increased dramatically since 2007. So the risk of 5% of the 30-year bond yield today is more threatening than 2007. Another chart you want to keep an eye on is the dollar. I'm looking at the weekly chart. It looks to me that the dollar is heading for an inverse ABC pattern, which means it's probably going to head lower. We're going to see more and more devaluation of the dollar. Now, that's not good for the U.S. stock market, so it doesn't matter if he's going to delay the tariffs or not. If the dollar continues to go down, then the main concern is the bond market, and that's going to lead the stock market down. How do you hedge against the dollar index going down? We talked about copper, we talked about metals, but you can buy foreign currencies. Folks have been saying throughout the last few weeks that I'm loading in a big position here for the Swissy and the Japanese yen. So folks, you can buy the FXF. This is the ETF, the weekly chart for the Swissy. And you can see that we have a bull flag pattern. As the dollar heads down, you're going to see the FXF heading higher. Now, I've been accumulating a big position here in the Swissy, either physical or by buying the ETF. You look at the Japanese yen, FXY is the ETF that you can buy. It shows right now a cup and handle pattern. And as the dollar goes down, the yen will head higher. So that works as a hedge against it. What else you can do? You can buy the old man gold. You're looking at the daily chart. We're above the 50 days moving average. It appears that we have a retest of the sloping line of resistance. We're going to find some resistance and then break above. If that is the case, then we're going to trade above 3,400 again. You're probably going to see 35 pretty soon. So gold is a hedge against the dollar, copper, palladium, a lot of commodities, a lot of other currencies. I'm going to stick to the Swissy and the yen. You can also buy Bitcoin if you'd like. Bitcoin been going higher as the dollar goes down, but at the end of the day, Bitcoin, is it really a risk asset or is it a hedge against the dollar? Hasn't been established yet. So far, Bitcoin has been passing a lot of tests. But we have to see the biggest one. What is the biggest test against Bitcoin? The holders of BTC happen to be the same holders of the big cap technology stocks. We have not seen yet what happens when we see steep declines in these big cap technology stocks. Will these investors be forced to sell their Bitcoin to cover for the margin and the loss in their stock portfolio? Well, that means that Bitcoin is a risk-on asset, just like technology. But if Bitcoin holds, despite the fact that big cap technology stocks are heading down and hedging against the dollar, then it is proving its status as digital gold. But until that battle is won, why not stick with the old man, the proven one? And by the way, we got the Bitcoin conference here in Las Vegas. If you're going to attend, I'm going to crash the conference and I'm going to squat down the podium and take a dump. I'm going to try to shape it as a tulip. So be on the watch out for that. But let's move on to the conclusion of this video. What do we have on the economic calendar this week? Tuesday, the 27th, we have a bunch of Fed zombies in Tokyo. Speak about Godzilla. Why are they in Tokyo, by the way, and why are we paying for all of this? Neil Kashkari, zombie from Minneapolis, and John Williams, zombie from New York. They're probably on a begging tour in Japan. Please buy our bonds. Please rescue us. Please don't raise interest rates. Please don't firm up the yen. But on the macro calendar, we have durable goods, we have the Case-Shiller Home Price Index, we have consumer confidence. And Wednesday, the 28th, we have another round with the Minneapolis zombie Neil Kashkari in Tokyo. And on top of that, we have also the minutes from the last FOMC meeting. But comes Thursday, the 29th, we have more macro data, initial jobless claims, then we have the first revision of the GDP, pending home sales. Then, of course, a bunch of Fed zombies all over the place, from Richmond, Chicago, Governor Kugler, San Francisco zombie, and Dallas Fed zombie, all of them talking. That's what they're good at. Then we finish the week, Friday the 30th. We have a bunch of economic data, and of course, the most important day from a macro perspective, because we have the PCE, which is the Fed's favorite inflation index. That's always going to be important, whether the Fed is going to cut rates or not. Right now, we're pricing in a cut in September and another cut in December. If we reduce the chances of a rate cut, that's going to be a net negative for the market. Then we have some retail inventories data, the trade balance, wholesales inventory. We have Chicago Business Barometer. And then on top of that, we have consumer sentiment. That's going to be the final reading, really important for us to look at now that the psychology dominates the market. And of course, after that, we have San Francisco Fed zombie Mary Daly. Now, in the earnings calendar, the big kahuna would be NVIDIA. That's a market mover. It's going to be Wednesday. We got important names like Costco, Salesforce, Ohana, PDD, Synopsys, Dell, Marvell, Zscaler, HPQ, and many more. Alta Beauty, I think, is going to report this week too. So we have a bunch to look forward to here, folks. But let's wrap it up right now. Folks, if you found the show informative, Help us out, return the favor by pressing the like button, subscribing to the channel, leave us a nice comment in the section below. And better yet, join us as a Maverick member here on YouTube or Patreon to access the daily show. You can do that in the links in the description of this video. But with that, folks, this is all I got for you tonight. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Hannibal, confess.
What is this divine-looking amuse-bouche?
If I tell you, I'm afraid you won't even try it. Bon appetit.
Bon appetit.